A Four Price Doji occurs when, during a particular trading period, the opening, closing, high, and low prices are virtually the same. This phenomenon signifies a period of extreme indecision among the market's participants, suggesting that neither buyers nor sellers could gain a strong advantage. Visualize a perfect balance on a scale where the weight of buyers' optimism is precisely counteracted by sellers' pessimism, leading to a state of equilibrium. Moving beyond the Four Price Doji, it's important to understand its significance in the broader context of market movements. This pattern often signals a potential turning point or pause in the market's current trend. Traders might interpret it as a sign to pay closer attention to upcoming price action or to anticipate a possible shift in market dynamics. For those analyzing these patterns, it's not just about recognizing the doji itself, but also understanding the market conditions that led to its formation and predicting the possible outcomes. Drawing from the analogy of a calm sea before a storm, a four-price doji might represent a brief moment of quiet, with changes on the horizon that could define the next wave of market activity. In considering what comes after detecting a four-price doji, it's crucial for traders to look for confirmatory signals in the subsequent trading periods. This involves monitoring for a clear directional movement that may indicate the market's resolution of its previously uncertain state. By doing so, traders can make more informed decisions, whether they're seeking to capitalize on an emerging trend or protect themselves against potential volatility. The five-candle gapping is a continuation pattern observed in the financial markets, highlighting a specific sequence of price movements over a defined period. This pattern is characterized by a gap that appears on the chart, signifying a break between two price bars where no trading occurs. In the context of the introduction titled The Tale of the Five-Candle Gapping, this pattern unfolds across five candles or bars on a chart, indicating a directional bias in price movement. To break it down, the first part of this pattern typically shows a strong directional move, reflecting either a sharp increase or decrease in price. It is followed by a gap, which is an empty space on the chart that results from a significant price jump with no trades occurring within that range. This gap is critical as it signals a continuation of the trend that was in place before the gap occurred. After the gap, the pattern generally includes a few more candles that move in the same direction as the initial surge, confirming the continuation of the trend. Understanding the five-candle gapping pattern is valuable for traders and investors as it helps to identify moments when the market is likely to continue in its current direction. Recognizing this pattern can assist in making informed decisions about entering or exiting trades, with the gap acting as a key indicator of momentum in the market. It is a concept embraced by both seasoned analysts and those still familiarizing themselves with technical analysis, offering insights into the market dynamics that can influence investment strategies. Identifying the five-candle gapping pattern involves observing a specific sequence of candles on a candlestick chart, which is commonly used in trading to depict the price movements of securities, commodities, or currencies over a set period of time. This pattern is recognized as a continuation pattern, suggesting that the market is likely to continue moving in the direction of the prevailing trend following the formation of the pattern. The five-candle gapping pattern is characterized by three main components. The first component is a large candle that moves in the direction of the current trend. This is followed by a series of smaller candles, typically three, which gap away from the first large candle, moving sideways or slightly against the trend. These smaller candles do not fully retrace the large candle's movement, indicating a pause or consolidation in the market rather than a reversal. The final component is another large candle that gaps away from the smaller candles and resumes the original trend direction, closing at or beyond the close of the first large candle. Traders and analysts interpret this pattern as a sign of market strength in the direction of the trend. The initial large candle represents a strong move in the trend's direction, while the series of smaller candles and the gap suggest a temporary pause as traders take profits or re-evaluate their positions. The concluding large candle, moving sharply in the trend's direction, signals a resumption of the underlying momentum and can inform traders about potential entry or exit points. Visualizing this pattern can be achieved by imagining the market as a scene where participants push forward vigorously, then take a brief rest to gather strength before resuming their push with renewed vigor. This imagery helps in understanding the dynamics indicated by the 5-candle gapping pattern, offering insights into the continuation of a trend and guiding trading decisions. The 5-candle gapping continuation pattern is a concept utilized in technical analysis to identify potential future movements of market prices based on recent patterns. This pattern involves the observation of 5 candles or bars on a chart, which represent a period of price action in the market. A gap within these 5 candles suggests a continuation of the current market trend after a brief pause. The gap effectively acts as a signal that despite the short-term pause, the prevailing trend is likely strong enough to continue. In the section titled Deciphering Market Sentiment, the focus shifts to understanding the collective mood or attitude of market participants based on price actions and patterns such as the 5-candle gapping. Market sentiment can be bullish, indicating a general expectation of rising prices, or bearish, reflecting expectations of falling prices. Technical analysts decode these sentiments by carefully studying price movements, volume variations, and patterns like the 5-candle gapping. By examining these elements, analysts can gauge whether the sentiment is inclined towards continued investment, favoring a bullish outlook, or towards selling off assets, indicating a bearish stance. Understanding these concepts does not require deep dives into complex financial theories, but rather an appreciation of the patterns and trends that manifest in market price charts. The 5-candle gapping continuation pattern, along with an analysis of market sentiment, provides a framework for predicting future price movements, offering strategic insights to investors on when to enter or exit the market. This approach aligns technical analysis with a pragmatic view of the market's psychological state, leveraging pattern recognition to inform investment strategies. The 5-candle gapping pattern, often seen in the context of technical analysis, is essentially a continuation pattern. This means it signals that the current market trend, whether upward or downward, is likely to persist beyond the appearance of the pattern. To envision this, imagine the price chart of a stock. A gap appears on the chart where no trading takes place, then 5 candles or days of trading follow. The direction of these 5 candles in relation to the gap helps analysts predict the continuation of the trend. The nature of continuation within this pattern is intriguing. It tells us that the market has taken a brief pause represented by the gap before confidently resuming its previous direction. This can be particularly helpful for traders looking for signs that a current trend has staying power, suggesting that entering or maintaining positions in alignment with the trend could be advantageous. In simpler terms, the 5-candle gapping pattern acts like a green light for traders. It reassures them that despite the pause indicated by a gap on the chart, the trend remains strong. This pattern, by highlighting the continuation of a trend, offers a strategic point for traders to make informed decisions in alignment with ongoing market movements. In the context of the 5-candle gapping continuation pattern, the section on confirmation and strength addresses how traders can validate and measure the robustness of the pattern. Confirmation refers to the evidence needed to determine that the pattern will indeed lead to a continuation of the current trend, and it often involves waiting for additional price action or trade volumes that support the pattern's predictive power. The strength aspect examines how convincing the continuation signal is based on factors such as the size of the gap, trading volumes, and whether subsequent candles maintain the trend direction without quickly reversing. This pattern is particularly compelling because it signals a potential pause in the market trend, followed by a likely continuation of that trend. For instance, in an upward trending market, a gap might occur with the price opening higher than the previous day's close, signaling strong buying interest and potentially more upside. For traders, spotting a 5-candle gapping pattern and confirming its strength through observed market behavior could be a key strategy in making informed trading decisions. Such analysis requires diligent observation of market movements, including how the gaps are formed, the behavior of the candles following the gap, and the trade volumes during these periods to confirm the continued momentum and strength of the market trend. The 5-candle gapping pattern is recognized in technical analysis as a signal for the continuation of a current trend. When understanding its reliability and the need for caution, it's crucial to consider several factors. Firstly, this pattern's reliability is informed by its occurrence within a strong trend where a gap is created between the first and the second candlestick, indicating continued momentum in the direction of the trend. The subsequent 3 candles should maintain this direction, solidifying the pattern's validity and the trend's potential continuation. However, caution is advised for a few reasons. The presence of this pattern alone should not be the sole basis for making investment decisions. Market conditions can change rapidly, and relying exclusively on one indicator can lead to misinterpretation of market signals. It is essential to combine the insights gained from the 5-candle gapping pattern with other technical indicators and fundamental analysis to make more informed decisions. This comprehensive approach helps in mitigating risks associated with relying on a single indicator and enhances the potential for successful investment outcomes. In summary, while the 5-candle gapping pattern offers valuable insights into market trends' potential continuation, it is crucial to exercise caution. Combining this pattern with other analysis forms ensures a well-rounded approach to interpreting market signals and making investment decisions. The 5-candle gapping pattern is an essential concept in technical analysis that helps investors identify potential continuation trends in the market. This pattern becomes particularly powerful when used in harmony with other analysis tools. For instance, combining it with tools like moving averages or oscillators can provide a more comprehensive picture of market trends. When we talk about moving averages, we refer to the average price of a security over a specific period. If the 5-candle gapping pattern emerges in the direction of the prevailing trend indicated by a moving average, it strengthens the reliability of a continuation signal. For example, in a bullish market, if a 5-candle gapping pattern appears while the price is above a significant moving average like the 50-day or 200-day moving average, it suggests the bullish trend is likely to continue. Oscillators, on the other hand, are tools that oscillate between two extremes, generally to indicate overbought or oversold conditions. When a 5-candle gapping pattern forms and the oscillator's value aligns with the pattern's implication, it offers an additional layer of confirmation. For instance, if the pattern indicates a bullish continuation and the oscillator moves from an oversold condition upwards, it suggests that the market sentiment backs the continuation of an uptrend. In summary, the 5-candle gapping pattern is a valuable indicator of market continuation trends on its own. However, its predictive power is significantly enhanced when it is analyzed alongside other technical analysis tools like moving averages and oscillators. This integrated approach allows investors to make more informed decisions by corroborating the continuation signals provided by the 5-candle gapping pattern with other indicators' insights. Navigating the pitfalls of the 5-candle gapping continuation pattern involves understanding its unique characteristics and challenges. This pattern appears within a trend and signifies potential continuation, but it requires careful analysis to avoid common mistakes. One crucial aspect is identifying the gap correctly. A gap in this context signifies a price jump where no trading occurs, represented by a space in the candlestick chart between two consecutive candles. For the 5-candle gapping pattern, this typically means observing a clear gap after a series of 4 candles moving in the same direction. Traders often encounter pitfalls when they misjudge the gap's significance or its position within the trend. It's essential to ensure that the pattern forms during a strong trend and that the gap does not fill too quickly. A gap that fills immediately might indicate weakness in the trend and reduce the reliability of the pattern as a continuation signal. Additionally, it is imperative to consider the volume. An ideal 5-candle gapping scenario occurs with increasing volume, which supports the continuation signal. A gap on low volume may not hold the same level of conviction, leading to false signals. Risk management is another critical factor when navigating the pitfalls of this pattern. Even with a correctly identified pattern, market conditions can change rapidly. Setting stop-loss orders and having a clear exit strategy can help mitigate potential losses if the market moves against your position. Finally, practitioners should utilize this pattern as part of a broader trading strategy, incorporating other technical analysis tools and indicators to confirm signals. Relying solely on this pattern without confirmation from other indicators can lead to misinterpretation of market sentiment and movement. In summary, to navigate the pitfalls of the 5-candle gapping continuation pattern effectively, it is vital to accurately identify the gap within a robust trend, consider trading volume, manage risk appropriately, and use additional analysis tools for confirmation. Taking these precautions can help traders make more informed decisions and potentially capitalize on the continuation of a trend signaled by this pattern. In discussing the 5-candle gapping as a continuation pattern, specifically focusing on strategies for entry and exit, it's essential to understand the core concept first. The 5-candle gapping pattern signifies a potential continuation of a current trend observed through a specific formation in price movements over 5 candles. Entry strategy. When identifying this pattern, investors should look for a gap that appears after a strong directional move. This gap represents a pause and is followed by the continuation of the trend. The optimal entry point is typically after the gap is observed and once the trend resumes. This approach helps in confirming that the continuation pattern is in effect and reduces the risk of entering during a false signal. Exit strategy. Setting an exit point requires careful consideration of risk management principles. A common practice is to place a stop loss just before the gap, as closing this gap might indicate a reversal of the trend. Additionally, investors may set a take-profit level based on their target return, which could be determined by historic price levels or a predetermined risk-to-reward ratio. In essence, the key to leveraging the 5-candle gapping pattern lies in the accurate identification of the pattern and a disciplined approach to entry and exit strategies. This involves careful monitoring of price movements and strict adherence to predefined risk management parameters to capitalize on the continuation of the trend while minimizing potential losses. Exploring variations within the 5-candle gapping pattern involves understanding the subtleties that make each occurrence unique, yet part of the broader continuation pattern family. This pattern typically signifies a pause after a significant price move, followed by a continuation in the direction of the original trend. Variations can be identified by looking at the size of the gap between the first and second candles, as well as the shapes and sizes of the candles within the pattern. For instance, a larger gap may indicate a stronger continuation signal. Additionally, the context within which this pattern occurs is crucial. If it appears in a strong uptrend or downtrend, it may validate the likelihood of trend continuation. Moreover, the volume of trading during the formation of the pattern offers valuable cues. An increase in volume, especially on the breakout candle, can confirm the strength of the continuing trend. Understanding these variations requires analyzing the specifics of each pattern, including the preceding market conditions, the gap magnitude, candlestick configurations, and associated trading volumes. In essence, while the core concept of the 5-candle gapping pattern as a continuation signal remains constant, recognizing its variations can enhance its application in making informed trading decisions. Paying attention to these details helps in deciphering the market's narrative, allowing traders to align their strategies with the underlying market momentum.